Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 21st of November. I'm Daniel Lam, your host for the podcast. Volatility is a topic that I have deep connection with, as I've been a derivative strategist for most of my career. Now, the initial perception for Trump 2.0 is we may see high volatility ahead for the S&P 500 index. But in fact, things are not so simple. Certainly the experience from Trump 1.0 is indicating otherwise. So let us dig deeper into this topic today. First of all, equity volatility premium has collapsed and bottomed post the US elections. Now historically, there is likely to be a re-expansion of the equity volatility premium, which we are already seeing with the gradual rebound in VIX, i.e. the short-term volatility index of the S&P 500. Those who believe volatility in the S&P 500 index would rise further would point towards a weakening economy, where there is increasing likelihood that the sectors would be moving in tandem. For example, sectors may all move down together on the back of bad economic news and rebound together on good news. Basically, there is little offsetting effect from the moves in different sectors. It's different in a steadily growing economic environment, where the idiosyncratic drivers on different sectors would, quote-unquote, trump over the broader macro factors, resulting in some sectors moving higher while others going lower. The moves would then be offsetting each other on a broader equity index level, resulting in lower volatility. So all it boils down to is the economy. This memorable quote from Bill Clinton in his presidential debate against George Bush Sr. Despite some soft data in the US over the past few months, there seems to be resilience in the US economy, such as the most recent consumer spending numbers, data that prompt Powell to say that the economy is not sending any signals that we need to be in a rush to lower rates. Now, back in Trump 1.0, GDP growth numbers were lower versus now. Inflation was below the 2% Fed target, while currently it is above. So the fiscal stimulus back in Trump 1.0 led to moderate rise in growth and inflation. Just about right, and volatility came down. Would we see the repeat of this playbook? Well, it is likely so at the initial stage, but the outcome could be different this time around for the medium term, since effectively one is adding fuel to the economy when it is already running well. So this can lead to, down the line, concerns about overheating and the return of volatility in the medium term. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.